Hey guys, I'm Chris.
And I'm Chris.
And welcome back to the Aspiring Millionaires channel.
And today's video is going to be about the elements of investing.
And what it takes to be an intelligent investor. Let's get into it. So the first thing you do is save.
And that means starting early.
Starting young, that's the key. A way for you to be able to save more is to reduce your expenses right off the bat. So that means not making dumb purchases, not doing the things that you wouldn't do out of the ordinary. Just be like if you watched our first video, you can see that we put a chart in there about dopamine levels and how your dopamine levels skyrocketed when you just went shopping and not actually bought something. So keep that in mind when you go to make irrational purchases, I guess.
It's pretty simple. If you want to save money, reduce your expenses.
The more money you don't spend, the more money you're able to save. And just kind of like act like it's a bill, just like the first thing you want to do is you pay your bills, right? You want to put your money into your savings so you don't, go out there and spend that money before you're able to save it. So to press on, start saving early a little bit more, there's a thing called compound interest. And this is like the number one financial tool. I think we go over it in pretty much every single one of our videos because it's so important. Compound interest is that money that you saved earlier is working for you, year after year after year. So if you go into a compound interest calculator online and you do like an imaginary number, $6,000 every single year for 50 years or 40 years or 30 years, you can see that compounding working for you.
To break it down, if you put $1,000 in a savings account that somehow earns 10%, next year,
hypothetically,
next year you'll have 1,100, and so it just keeps on building year after year.
And the money just keeps compounding and compounding. Remember, compound interest. The most important thing for you is for you able to build wealth in the future. But the bottom line is start saving now. So after you saved up all this money, what are you gonna do next? You're gonna go index every single bit of your money because that's the safest and most way you're gonna get the most out of your money. See, people think that you should invest in. Other people think you should invest maybe retirement in single stocks or mutual funds, but the statistics on those are not very good. I mean,
years after year, the stock market has returned 8%. So
it's really hard if you're a mutual fund manager or just an independent stock investor to actually go out and beat the market. I mean, the studies have shown year after year after year, and what we're basing this video on is a book called The Elements of Investing. And in that book, it gave us many statistics like after a 20-year period, 68% of all index funds outperform all the mutual funds. So
that explains it for itself.
Pretty much. I mean, and if you want to go look up for yourself all the index funds information, the statistics, go ahead. It's going to give you the exact same thing.
So you should also diversify between the U.S. stock market and the international stock market.
You got to remember the U.S. stock market is only 40% of the international GDP. So let's say some of your equities or bonds went down in the U.S. That means you're okay because you diversify domestically, whether in China or the European stock market. See, they have stock market indexes just like we do. We have the Nasdaq and the what else do we have? The S&P 500.
Yeah, the Russell 2000.
Russell 3000. They just have stuff just like that. And indexing over so you can get a whole entire world index fund too. We went over that a little bit in the index funds versus mutual funds video. We'll link that actually in the description and on the video right now, so you can go watch that so you can learn everything about indexing. So when you go actually save all this money and put it into your Roth IRAs and your traditional IRAs, you know where to put it, to invest it.
You're definitely going to want to look for fees when you open in a brokerage account and when you're looking to invest in these index funds.
You just want to go with the lowest fees overall because it's going to give you the highest rate of return. Obviously, I mean, just simple math. If you are, expecting to earn 9% in the stock market in these indexes, and your fees are higher up to like 0.84%, which is typical of a mutual fund. See, that's why we don't recommend mutual funds. Also, is because for the mutual fund to actually outperform an index, it has to go 4.3% higher than an index fund. So just look for those fees. Be cautious of them, but I mean, most indexes are going to give you low fees, around like 0.1% at the most. Or point 13%.
Yeah. So before you stop this video and dump all your money in there right away, there's this thing called dollar cost averaging. So there's this thing where
when the stock market rises and when it falls, you just never know when to you put your money in. So if you just put a little bit in here and there, like let's say you have the $6,000 max for the Roth IRA, right? Let's say you put in you divide that by 12. I think that's what, $500.
Yeah.
So you just put $500 in there a month, because sometimes the stock market's gonna be high, sometimes the stock market's gonna be low. But the statistics show, especially from that book, that the dollar cost averaging gives you a better rate of return over the long term. So
Rather than just dumping your money in.
You never
Space
want
out
to
your payments.
Yeah, space out your investing and stuff.
As you get older, stocks become a little bit more risky, and so you're probably going to want to sell off more of your stocks and keep more of your bonds.
Just rebalance your portfolio to go more towards bonds, because as you near retirement, you don't want maybe a stock market crash, which isn't going to hurt too much because you're going to already have that, stability in there, but you're going to want to shift it a lot more to bonds, and you'll progressively do that as you get older. If you're in your 20s and 30s, you might have it 100% in equities and 0 in bonds, because you can take that extra risk. Some people even recommend that you go up to, in your 40s and 50s and you don't even take it out, because depending on when you want to retire. But if you don't like as much risk and you're not very good with volatility in the market, then shift more towards bonds.
If you don't want to manually sell off your stocks, there are also different accounts where it'll automatically sell off stocks as you near closer to your retirement.
So if you want to get the most from your index funds investing, you're going to want to diversify. We've kind of already talked about that, but we're going to go in a little more detail what diversifying is, because this is the third thing we're going to talk about is diversifying. The first thing is rebalancing. Now, what rebalancing is like if you want your equities and your bonds to be like 80 to 20. Let's say you're in your 30s and you want an 80-20 because you want to protect against volatility a little bit, okay? So what might happen is like the stock market go up a lot and then the bond market go down. So what you want to do is you might have at that point in time 85% equities in there instead of 80. So you want to sell a little bit off and buy more bonds at that point in time. Or what might happen is the bond market might go up and the stock market might go down. So you might be looking at a 60 to 40. So at that point in time, you might want to invest more into equities because the market's low at that point in time and plans on going back up. So that's what rebalancing is.
So like we said earlier, you're probably going to want to invest in bonds and invest in stocks, as they both have different advantages and disadvantages depending on your age and what you want, what are you looking to get out of it.
How you can do the asset allocation differently through various securities.
So you're then going to want to invest, like we said earlier, invest across time, which means putting in your money at different times across the year. So the stock market might be higher in January than it is in March, and so
you want to do the dollar cost averaging like we were saying earlier.
So you're also probably going to want to put your money in different markets, such as the U.S. market or the international market.
Or the total world market, because like we said earlier, 40% of the world's GDP is only in America. So that leaves yourself up for volatility if you only are invested in the U.S. stock markets. So that's another thing to think about when you go to diversifying your portfolio. So we pretty much gave you everything you need to know about investing your money in a good, well-rounded portfolio with index funds, and just being able to save, just everything an intelligent investor needs to know. But just the basics. There's a lot more to learn, but just the basics of everything an intelligent investor needs to know.
The fifth thing we're going to go over is avoid blunders or mistakes or problems that arise in your investing career. So the first one is not being patient. Patient is a virtue in investing in the stock market. It is essential to be impatient when you're investing in the stock market. There's going to be good times, there's going to be bad times, there's going to be the average times.
There's two guarantees when you're investing. Stock market's going to go up and it's going to go down. Trust me, it's going to go down. There's probably most likely going to be a crash in your investing career. When it goes down, that's the worst time to take your money out. Because people say, invest when the stock is low and then sell high, right?
So why would you sell low? It doesn't make sense.
Exactly. So
you're at a loss.
People who say they lost their 401ks, when the stock market crashed, is because they took the money out and they didn't wait for it to go back up. The time when it's down is the time when you
put more money.
You buy the most. You put most of your money into equities.
The second thing is overconfidence. People think that they know the market. Statistics have shown that most people don't beat the market. So why should you?
There's only a select few people in history like Peter Lynch and Warren Buffett and these type of guys that have actually ended up beating the market. And the only reason they beat it is because of like insider investing. They knew that the stock market was going to go up because Warren Buffett believed in himself, or Jeff Bezos believed in himself because he knew his company was going to soar.
If you want to study the market for years and years, then yes, you might learn some tips and tricks on how to beat the market.
But still, it's going to be extremely hard.
But if you're just an average person and wants to take it, but if you're just an average person and wants to take into the fact that investing is pretty simple with index funds, then invest in index funds and basically have the average of the market, which has returned around 8%.
Which is really good, and it's going to set you up for wealth in the long term. But thinking that in the short term you could beat the market, just look up the statistics we were looking at. We saw earlier where mutual fund managers, people who study the stock market, and they have these degrees and everything that puts them towards being able to outperform the market, and they still don't. The next mistake you do not want to do is taking your money out of the retirement accounts too early. That is probably honestly the biggest mistake you can do with your retirement, is if you did all this long-term investing and then you took your money out before 59 and a half. Unless you have some certain rare case where you qualify for an exception for this retirement rule, or you're sick or something like that, do not take your money out, because I'm pretty sure the 10% penalty tax on that money. It's a ton of money.
So something that we touched on earlier is you're going to want to minimize your investment costs. So you're going to look for accounts which allocate low fees to yourself. I mean, I think E-Trade is like $7.95 a trade, and around
which isn't going to matter too much in the long term, because if you're not doing day trading or something, you're only investing there once a month. That $7 isn't going to hit you. We're talking about the fees that mutual fund managers seem to get by you on, which is like when you go to invest in a mutual fund, it can either be 5 3/4 sometimes, or it can be 2% every single year. So with index funds, you're generally not going to get those higher fees on there anyway, but just look out for them, because sometimes they'll hit you with that. So last thing we're going to go over, and equally as important, just because it's last doesn't mean it's any less important, but it is saving on taxes.
So when you're investing, every dollar matters. Compound interest is your best friend when investing. So now we're going to go over a brief overview of the different accounts that give you tax breaks, either when you put your money in or you take your money out.
The first one we're going to go over is the traditional IRA, and this gives you a tax benefit right up front. So when you contribute to a traditional IRA, as opposed to a Roth IRA, you can reduce your tax bill right up front. So if you invest the full, I think $6,000 for this year, the full $6,000, you get that reduced from your taxes immediately. But when you take that money out in retirement, you do pay taxes on it. So I'd say I would go with a Roth over anything, because it's not taxed when you take it out, and obviously the money grows tax deferred in both of them. But with the Roth, it's not taxed when you take it out. With the traditional IRA, it is. So you're going to be taxed in a higher tax bracket.
So we're going to wrap it up. Our final thing, keep it simple.
First thing you do to keep it simple is save early and regularly. Remember, we're just kind of going over everything we had just talked about. The second thing is use the help of your employer plan, for like a 401k or a pension plan or something like that, and Uncle Sam's basic retirement accounts. Anything you can do to reduce your taxes, use those.
And then the third thing, set aside a cash reserve.
You need to have an emergency fund before you go in investing, because if you go and invest and you have an accident or something, your car breaks down, you need that extra bit of money, you don't have to go take it out of your retirement accounts or something. You can take it out of that emergency fund. Remember, just for emergencies though.
So our next thing, make sure you're covered by some kind of insurance, so you don't have to reach into your cash reserves or your emergency fund for extra money.
Remember, everyone needs insurance. Just think, you just want it there just in case, You always think it might not happen to you, but sometimes it does. Diversification is going to reduce your anxiety so much. If you know that your money is in 100% of the world's market, if you invest in a total world market, or you just index every single bit of your money, you're going to be fine. If your asset allocation's fine, you make sure you rebalance. Just keep it simple in index. Indexing just makes everything so much simpler and just reduce your anxiety as a whole.
So make sure you avoid all credit card debt at all costs. I mean, debt is your worst enemy. The interest on it is horrible.
Remember that your biggest wealth building tool is your income. So the more money you have of it, the more money you can actually save and actually go invest. So if you're paying these APRs that are 18 to 24%, you're not going to be able to build wealth. I mean, you're allowing them to build wealth, because at 18, 24%, imagine if you can get that kind of return. That's what those credit card companies are thinking.
And the last thing, avoid mistakes, blunders, or problems. And if you watch this video, you're probably going to avoid a lot of those now.
Just, go back to that avoid blunder spot, review it, put it in your head that you're going to avoid Mr. Market. You're going to avoid him telling you, take your money out when, it gets scary. You put more money in when it's when it's up. Just think of long term. Don't let him get into your head and make you take your money out when you shouldn't. Avoid those penalties. Use low cost index funds, and you'll be just fine. So that was the elements of investing. If you use this video and you take everything from it, if you were taking notes and everything, or even if you weren't taking notes and you were just listening, it's going to make you a better investor, more intelligent investor. Pretty much in this video is pretty much everything you need to know to become wealthy when you retire.
So if this video helped you, or you think you're going to help your friends, please leave a like, share it, please. It means the world to us. We appreciate it.
Go share with them so they're not asking you for money in retirement, because that would be awful if you're the only rich person when you retire. So that's going to pretty much do it for us. If you like you said, if you enjoy this video, please like, share, subscribe. Go down in the comment section, leave us a question about the video or something. If you had a question about it, we'll get on there real quick. We don't get very many comments. That's gonna do it for us. Thank you guys for watching. Peace out.